Well, hi, everybody. I'm looking around thinking, well, there's not too many people in here, but given this topic, I'm thinking there shouldn't be too many people in here, actually. You guys are probably curious, okay, what is there to say about IFRS adoption and current SEC activities? And I'll say two things. One is not a lot at the moment, but the second thing I'll say is I'm going to make this is going to be far more interesting conversation than you thought it might be. I can promise you that. My name is Mark Sheffers. I'm the CEO and founder of Audit Analytics, or Ives Group up here. You might be familiar with Audit Analytics if you read the the CFO Journal, part of the Wall Street Journal. They do their CFO big number every week, and I would say probably once a month we're providing the data for that big number. So we get quoted a lot. We're basically the official collector of a lot of different kinds of financial reporting and financial control related information. What I mean by that is nobody else collects it, and nobody else really wants to collect it. But we happen to be the collector of things like financial restatements, Section 404 filings, control filings, Section 302 filings. We collect data on litigation, reported litigation, on auditor opinions, on auditor fees, we just collect data on all kinds of stuff that some people care about and most people don't. Our subscribers actually are fairly interesting. They're, just to kind of give you a perspective, they include all of the major accounting firms and all of the major financial regulators. The SEC is a big subscriber, the PCAOB is a bigger subscriber, and then we also have a series of other letters-related entities that subscribe: the IRS, the GAO, the AICPA. So we have a bunch of not-for-profit and regulators who subscribe to our data, and they use it essentially to go after people like yourselves. We also have, the data set is also an interesting one in that everything we do is what I would describe as research quality. When we collect something, we collect it in its entirety. We don't, for the most part, in its entirety. And what that means is that we also have a lot of subscribers who are universities, who do research. If you're looking at any kind of accounting or auditing or financial research, we have about 250 universities around the world that subscribe to our data. And then we have a kind of a smattering of other users, investment banks, law firms, insurance companies, and corporations. You'll see from some of the stuff that I put up here why that might be. Now, one of the other things I've done over the years is I've gotten involved in, I started out at PricewaterhouseCoopers. Well, it was Pricewaterhouse when I was there. And since then I was a CFO for a company, a large international mining company, for a period of time. And later a forensic accountant, litigation consultant, and prior to founding Audit Analytics. Now, because we get involved in a lot of regulators, they ask us a lot of questions about public policy stuff. Questions come up. Should 404B, that being the auditor's attestation on internal control, should that be extended beyond accelerated filers, small companies, et cetera? And when I was asked to do this presentation, I thought, okay, this is kind of interesting. I'll start with the IFRS adoption. Now, this is interesting to me because I actually initiated a comment letter on this topic. It was related to the SEC roadmap. I initiated a comment letter with a co-author of mine. We co-author 3 books on accounting ethics. They're graduate level texts. And we thought, well, this is kind of an interesting topic. Let's research it, and let's write a comment letter on the IRS, I think they called it the roadmap, right? If you guys remember, the roadmap for IFRS adoption. That was the thing. So we actually started the letter with we're not for or against. Most people write letters like that, they're for or against before you even start. They're trying to make whatever case it is that they think is the best for them. And so we said, oh, we're not for or against, we'll just take a look at what the issues are. And because we've done a lot of research for our ethics books on kind of the relationship between, the role of the SEC, the 34 Act, the role of the FASB, their interaction between the SEC over all the years. So we had all this kind of background already. So we wrote this comment letter, and I sent it out to some of my friends at the big firms. I said, hey, we did this comment letter. We think it's really interesting. In a nutshell, we said, it can't be done. IFRS adoption, the roadmap, can't be done. Okay. I'll explain that in a minute. And so I sent it out to some of my friends at the big firms, and of course they're our big subscribers, so I have to pay attention to what they say. And I got back something saying, basically, we understand what you're saying, but we don't like it. We don't like what you have to say, because we want IFRS adoption. We want the roadmap. Okay? So I said to my co-author, my ethics book co-author, sorry, Michael, you're going to have to put your name alone on this letter, because I want it to go in, and we're not going to, I just can't put my organization in any kind of difficulty because of some sort of public policy question like this. So Michael sends it in, Michael Pekulik. And by the way, if you're interested in reading the letter after hearing me, just type in the search button Pekulik, P-A-K-A-L-U-K, in the search on Edgar, and his letter will come up. So anyway, Michael submitted it, and within 24 hours, he had gotten a call from the president of NASBA, the National Association of State Boards of Accountancy. He got a call from the president saying, my God, that's such an amazing letter. I can't believe it. It's so brilliant. I have sent it around to everybody I know. Okay. Within a couple days, Michael had gotten a call from Bob Herz's office, who was the chairman of FASB at the time. This is a really incredible letter. Would you come in and give the FASB a private seminar on it? Okay, sure. So Michael did that. Jim Croker, SEC chief accountant, gets it. Like, oh man. So this is going back to, I forget what year, 2008 maybe, 2007, I don't remember exactly, but at the time, if you remember, IFRS was, the skids were greased, it was a done deal, you were going to have to convert, it was just a matter of the timing, it was going to be 2011, it was going to be, and then since then, you've gotten a whole series of, right, kind of, it's going to happen, it really should happen, blah, 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 there's been a change at the top, there's been, the simple truth of the matter is, I thought it was interesting that someone asked me to talk on this topic because you don't have to worry about IFRS adoption. It can't be done. It can't be done without changing the 34 Act. It can't be done without a congressional involvement. That was kind of the foundational thing that had to take place. It has to take place. And I don't know about you, but I'm not seeing much of anything going to go through Congress in the near future that's going to change the 34 Act or, in this case, take away an incredible amount of authority from the SEC, because that's what would happen. What were the issues here? I put some of them up here. You have to understand, the SEC's job, when the SEC was created, one of its most significant roles was to make sure that the quality of financial reporting and the consistency of it was, that was what was necessary. And it was actually in the Act itself and the history. If you go look at the history of the Act, they could have, there was a decision to be made how to do that, whether to involve some sort of private involvement, private company, the accounting firms, the profession, et cetera, or not. And the decision was made, it's very clear, that the accounting profession was to be an integral part of this, but the SEC would oversee it. The SEC basically has to approve everything that FASB puts out in terms of financial reporting. Now, sometimes they disagree a little bit and they put out a SAB, okay? But generally, that's been the role and responsibilities. And the SEC and the FASB have worked together for 75 years to do this, to accomplish this. Brilliant, brilliant people working on the most difficult accounting-related and financial-related reporting issues. IFRS comes along, and I don't know if you guys have probably sat in, if you've ever sat in an IFRS discussion on IFRS. I was giving a presentation actually for the New York State Society of Securities Analysts one time, and the guy right before me was the vice chair of the IASB. And I was very interested in listening to him talk. And basically, his talk was, this is going back again to this time frame, the U.S. should adopt IFRS because we're smarter than you are. That was the gist of it. We're smarter, our standards are better, and that's it. And you can hear a little sarcasm in my discussion here, my comments, but that may or may not be true. It could be that some of their standards are better than the FASB's. But to just kind of accept that, you have to throw out 75 years of the accounting profession and some of the best accounting minds and fairest minds at both the regulatory agencies and at the accounting firms being wrong about all this stuff. So you have to kind of cast that aside. One of the big issues here, from a legal perspective, was the discussion about public interest. The SEC, the FASB, have a public interest as defined by them, for them, is about American national public interest. It's about what's best for this country and what's best for the investors, what's best for, and public interest for the IASB is something different. That's not what's meant. Public interest could mean anything to the IASB. If you look at their founding documents, I'm not even sure I would even understand what it meant. So the question of public interest came up, and we discussed it in this paper. The question of comparability. That's one of the big assertions of adopting IFRS is it provides comparability around the globe. It's just better to compare. You can get, financial statements from China is better compared to financial statements from France and the U.S. if everyone's using the same standard, except IFRS doesn't require the same standard. It's affected by the legislative requirements of each country. And I'm not going to go into a kind of a critique of IFRS. I don't mean to do that. I just mean to say, to me it was interesting to get this presentation because from my perspective, from that date that my co-authors submitted that letter to today, what you've had is you've had the screeching halt of the adoption of IFRS, and what you've had instead is a conversation about conversion. FASB, IFRS, where they're going to work together and they're going to find, essentially, as I talk about in my fourth item here, comparability versus the most truthful translation. Comparability doesn't mean anything if the translation's not the best one. What does comparability mean? I mean, it doesn't mean anything of any significance. What you want is, as accountants, as CFOs, as auditors, as regulators, what you need is the most truthful translation of certain economic activity. That's what you need. I mean, we're translators. At our core, we translate economic activity into something that people can understand. So what you want is you want the most truthful translation. You don't want two bad translations so that they're comparable. So the conversion process makes a lot of sense. And there's a lot of people who, kind of like whatever's being discussed, there's a lot of people that understand that, and that's what they're really working towards, is basically a new set of standards that the FASB and the IFRS or ISB will put forward. Now, that doesn't mean that the ISB is going to accept that, but that's what you're getting right now, and it's going to take a long time. And so my initial assessment is, IFRS, don't worry about it. It's going to come piece by piece. That's what you're going to get. Piece by piece.
Can we interrupt?
Yeah, please do.
So is the implication of that the IASB is going to get a little bit closer to the FASB model, meaning that IFRS will be more rule-based than it was originally conceived to be, and it will come a little closer to GAAP, because GAAP is a rule-based approach, and we got a gazillion rules in GAAP for everything you could possibly conceive of. There's a rule in GAAP.
Yes.
And IFRS is the opposite. So are we basically muscling over Brits and everybody else in the rest of the world and telling them, you got to do business the way we do business in this country?
I'll tell you what I think we're going to get. It's not that. What I think we're going to get is we're going to get a more expansive principles and rules-based set of standards where the rules are understood. The rules do not trump principles. That's kind of the key thing. That's always been kind of the fundamental approach. You have basic principles that you apply. Rules are put in place so they help you. They make it more efficient when you're doing things. If you know what the rule is, then you just follow it. It makes it more efficient. You don't have to think about everything. You don't have to reevaluate everything. So you want rules and you want principles. Now, IFRS, certain aspects of IFRS are more rules-based than FASB. There's certain, you think it's principles-based. It's not, depending on what it is. It's this massive number of rules. Neither one of them is strictly rules or strictly principles. What you're going to find out, I believe, is both. Actually, let me give you a little, since you guys are kind of maybe are interested, I think this group might be interested. Lehman Brothers, Ernst & Young. If you remember, there was a big kind of hullabaloo on the failure of Lehman Brothers about how certain repo transactions were recorded, and it looked like to me like a fairly clear-cut example of principles being that Lehman Brothers and Ernst & Young overlooked the principles to apply rules which they knew would misrepresent the actual transactions, right? That's kind of the standard fare that gets described. Now, so anyway, Michael and I in our latest ethics book, we said, okay, let's write up a chapter on Ernst & Young and Lehman Brothers. And lo and behold, we did all the research and we found out that it wasn't that they were following the rules and disobeying the principles. They were obeying the principles. What do I mean by that? Well, if you go back to the financial crisis, a large part of the financial crisis could be described as how FAS 125, I'm going to date myself here, and FAS 140 were interpreted. Financial transactions, how they're recorded. And the principle that was applied was a control principle. And with the control principle, you got all that nonsense about, Enron. Enron had $38 billion of unrecorded liabilities, courtesy of the control principle. SPEs, if you remember, right? The control principle. At the time the control principle was put in place by FASB, all the accounting firms objected. They wrote letters. Bob Herz wrote a letter when he was at the accounting firm before he became the chairman, saying, don't do this. If you do this, you're going to create all kinds of problems. Well, they got all kinds of, so you had a problem. The problem you had is they were following the rules and the principles. What do you do then if you're Ernst & Young? Well, if you don't follow the principles and the rules, then you're just creating chaos. So it was broken. The principles were broken. And in fact, I would describe much of the last decade, FASB's job much of the last decade, it was fixing FAS 125 and FAS 140. That's what they've been doing, trying to fix them. Did it have a real effect on the world? Yeah, actually, a dramatic effect on the world, on the capital of financial institutions, on how they were recorded, how they're measured, how people had to put in. It was really kind of catastrophic in a way. Anyway, that's my. Okay. Any other questions on IFRS or rules-based, kind of principles-based stuff before I move on? Okay. Okay, that title's not quite right. This is just SEC activities. Okay, I'm going to move on to the SEC activity part of this. The answer to the question, what kind of SEC activities are going on, is not much. For you, for most of you, not much. Unless you're a registered investment advisor, a broker, dealer, a rating agency, or financial institutions to some extent, just the normal stuff. They're going to go after you committing a fraud. You know that, and in fact, I was reading that, the new chairman, Mary Jo White, is the third boss in 9 months. 4 of the 5 agency division chiefs have stepped down, including Corp Fin and Enforcement, and the chief accountant's office. 4 of the 11 regional directors. So the real question is, nothing much is happening, but when those new people come in, what kind of policy impact will that have? And we don't know the answer to that question. I couldn't tell you. So because I couldn't tell you what's going to happen, I decided I'm going to predict a couple things. Okay, I want to predict. I'm going to use some of the data that we've collected. I'm going to predict some things that are going to happen. Okay, and you guys can, email me or ping me if any of it happens. Okay. 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 The first thing I did was something that you might find, interesting. One of the things we collect is comment letters. We have 200,000 plus comment letters in a database. The taxonomy that we extract the data from, using analysts, not text searching, is 4,000 items deep. That's obscene. It's absurd, I know. comment letters, if you guys have been involved, they're complex things. They ask a lot of different things. Okay, so what I did is I took one of the 12 divisions at Corp Fin. Everyone's broken into 12 divisions. I took one of them. I took the last, I think it was last year, I forget, of letters within that division, and I just gave you, here's your top 20 issues, accounting-related issues that the SEC is focused on over the past year. This is what they care about. And I did it in the, I took the electronics and machinery division. You know, they all have different divisions. So your own division is going to be different. But I just took one of them. Now, fair value measurement estimates for electronics and machinery office, that's the number one issue they care about. So in your, you know, for your corporations or your clients or whatever, this is, you can predict. You can predict you're going to get a letter. And it's going to ask a question on this. Segment reporting, and I'm going down here. I won't go through them all, but it's in the presentation if you want to take a look at it. Non-accounting related disclosure. I always find these more interesting than the accounting related ones, because this is what the SEC is looking at every day for this particular division. This is what they care about. Liquidity, they care about your business overview descriptions, and even down here, let's see, what's it? Oh yeah, I like this one. This terrorist nation sponsor reporting, that's getting big. I know you think like, why, you know, like, why, right? They want to know who your third-party experts are. This is new to the list, trade restrictions. I don't even know what these letters are for. But in this particular division, there's some like, if you're in this industry or these industries, you can expect to get, you know, you could predict what you're going to get in your next comment letter. Now, comment letters are, what we've found is that, you know, under Section 408 of Sarbanes-Oxley, the SEC is now required to look at, the Corp Fin is required to look at every filing for every public company at least once every 3 years. And what that process involves is they have about half lawyers and half accountants. And they go through a process where a lawyer looks at it, an accountant looks at it, they convene, they pull together a letter, and then they send it out. It's pretty simple. If you're a big company, a large accelerated filer company, you're probably getting these about once every 15 months. They don't wait every 3 years. If you're a smaller company, you might get it every 3 years. If you have anything, like they get all of our stuff, anything pops up, restatement, et cetera, you're going to get something. They're going to take a look at you. Okay, one of the data sets that we collect information on is restatements. You can see here that, I'm sorry, let me go back here. Let me go back. Okay, let me press the right button. Okay. You know, it's a pretty consistent number of restatements overall over the past, like these are errors, you know. Now, one of the most interesting things to me about restatements is that almost 90% of them consistently correct understatements of, I say understatements, okay, overstatements of income in previous years. I always found that really interesting. My guess is that if the SEC is going to look at anything, if the PCAOB is going to look at the auditors who are looking at you, kind of audits, that question is going to come up. Okay, why is it so high? Is it just a matter of kind of an inherent bias that management has? We're going to find everything that's good for us, and we're going to not find everything that's bad for us. It's an inherent bias. It's really interesting to me, 85 to 90% consistently year after year.
What's shocking about that graph is that there's no year when restatements were less than filings. And can you explain why they peaked in 05, 06?
Yeah, I mean, that was your implementation of 404B, the auditor's attestation on internal controls, which, by the way, I'll just throw out this additional bit of information, which is kind of, I get a lot of data, so I see these trends. But one of the things that's really interesting about 404B, the independent auditor's report, is that it used to be that the rate of CFO dismissals after a restatement was considerably higher than the rate of audit firm dismissals after a restatement, or I would say before and after, kind of in that realm. It used to be that the audit firms kind of skated a little bit. That trend has turned around. And I think it's because the audit firms, when an audit firm has the responsibility, an independent responsibility to assess controls, and they miss something that's materially, material error, then they have to take a little bit more responsibility for it. Do you have a question?
Two things. Just to give some context, if you will, for those numbers. Do you know the number of U.S. accelerated filers throughout that period, and whether it increased or decreased, so we can look at it from a percentage standpoint?
Yep.
And I guess the other thing that is alarming, I guess, is you would think the trend of that going from 05, 04, 05 when SOX came into being, and it decreasing down through 09, that it would have continued to go down as far as the number of entities that were having restatements, but it's starting to trend back up.
Yep.
Why do you think that's happening?
Well, you're exactly right. This blue chart here is your accelerated filers. These are your larger companies with restatements, and it's trended up now for 4 straight years.
PCAOB hasn't been beating up the auditors for the last 6 years.
No, you're right. I don't know if it's a big enough number to, sometimes these things occur because there is some particular focus. For example, some of the next charts you might find kind of answer some of those questions. But it could be that there's been a big focus, for example, on cash flow statements. Cash flow statements have arguably become more important to investors than net income statements.
You mean a post-reporting focus?
Yeah, that they're
not looking at it before they
No,
report?
what we're doing is we're saying that the allocation between cash flow from operations, cash flow from investing activities, et cetera, that hasn't been correct. And sometimes that's incorrect because of transactions that have occurred, or kind of, sometimes it's, raisings of funds or whatever, but people haven't done it properly. So there's kind of a restatement of those.
So it's more of a classification issue?
Classification.
To a number being incorrect?
That's right, but it's significant in terms of how the investor perceives the cash flow from operations is kind of the, that's the thing that most people care about. It's kind of...
So you're referring to changes in financial statement line items and how it would affect an end user.
Yes.
Whereas in the past, perhaps they were saying, well, is it material to the balance sheet or the income statement or that particular statement? And now they were focusing more on changes or shifts in line items. It's interesting, though, to your point, it's trending back up, but there's a lag, and I think some of it's politically driven, because in 07, 08, at least in the financial services industry, you have failures like, Bear Stearns and, Lehman and all that stuff, right? And I think then there's some political component that's pushing the SEC to look at certain things, and there's a lag. So you start seeing it trend back up not until '09, '10, even the Madoff thing, all these things I think are factors. A lot of people felt that during that whole time, the SEC was asleep at the switch, and they may have been, right? So what happens? They're forced to start looking at things again.
Yeah, I don't.
So
It's,
there are a lot of components.
is it, it's,
But these aren't restatements that are being driven by SEC review, are they? I thought these were.
No, no,
company-
they're just-
company additional review,
yeah.
and come back and say, oh, we have.
let me get through the. Let me do this. Let me get through the restatement categories entirely. You might have a kind of like it may fill in because this is kind of your broader numbers. That was just a chart that breaks them out by industry. Largest negative restatements. Now, what's interesting to me about these, you can see, you talk about pre-404, right? I mean, these things are getting big because they're going on forever and nobody's picking them up or nobody wants to pick them up and, they just keep getting worse and worse. These are your largest ones. And in fact, not only your largest ones, but this one were foreign filers. So, that tells you something else. This is the actual companies themselves. We track why there were errors. Debt, quasi-debt reporting, tax expense benefit, cash flow statements, acquisition, mergers, issues, revenue rec, accounts, loans receivable, and liabilities, payables, reserves, et cetera. So our taxonomy is about 40 or 50 items deep, kind of when we track all these things. But you can kind of see here that it used to be that this debt equity thing, nobody really knew how to record it properly. So there were a lot of restatements related to that. But that's come down now, and they're all kind of in this funny window here, which I don't really know how to explain as an overall percentage of the kind of errors that are being found. Now, this to me is my first prediction. A reissuance restatement. This is a term, it's a kind of a term that's come up recently. I think we coined it. I'm not sure. Maybe we did, maybe we didn't. These are the restatements that, if you remember Glass Lewis, so Glass Lewis still does stuff for proxy stuff, right? Glass Lewis, when it was run by, let's see, who's the guy? Former chief accountant at the SEC. Come on, someone help me. It'll come to me in a second. Anyway, they used to refer to these as stealth restatements because they're restatements in the actual filing. In other words, beginning retained earnings is changed. There's no reissuance of any other financials. Beginning retained earnings is changed. There's a footnote in the filing. It happens when the filing occurs. There's no notification. There's no 8K. There's no nothing. So the marketplace finds out about it when they do the filing. And that's because, presumably, the materiality level is such that no previous year is separately, individually, materially affected. Okay, that's kind of the justification. My first prediction is there's too much room for some companies are going to abuse this. It's just so predictable to me. Some companies are going to abuse this, this process, and they're going to stick some really material stuff into this kind of restatement. And then there's going to be a hullabaloo and a, Wall Street Journal this and a blah, blah, blah that. And so there'll be a pendulum swing back towards, sorry. Okay, that's my first prediction. It is, to me, I don't even think it's a prediction. It's a near certainty to me. Okay, let me just finish up the conversation about reissuance restatements. This is the nature of restatements has changed. The nature of errors in financial reporting has changed fairly dramatically. If it's true that these are all fairly done, not material or not material enough to reissue previous year's financials, then that's a huge step. That's a huge quality indicator of the quality of the controls out there, the systems in place, what's going on, essentially. And I think that, you know, a lot of the data that we're collecting indicates that the quality of financial reporting is up considerably. Okay, now I've got another chart here. I'm going to go into a different category here. This is going concern opinions. Now, to me, this is interesting in the sense that, yeah, you would expect that the, you know, the highest percentage of them would occur in the, you know, the recession that hit in 08, 09. Okay, this is the actual number of them. Okay, this is new going concern opinions every year. This is your kind of your, in a way, a leading indicator of what the financial stuff, what this financial stuff looks like, what the kind of the overall public marketplace looks like. This is the lowest number, or the last 2 years really, the lowest numbers that we've had in recorded history. Those are new going concern opinions. That you would think that would indicate kind of, you know, things are getting better. This is your new, of the overall new and then existing, repeated 1 year after another. Now, I think what's interesting is this chart, and this is to be another of my predictions. This number 140 is the lowest of any time that we've recorded it. And it represents companies that have come out of a going concern opinion and gotten a clean opinion. They've emerged. They haven't gone bad, they've gone good. They're not breaking bad, right? They're breaking good. Okay, so breaking good, 140. Why? How could it be that that's the lowest, like we're hitting the lowest numbers? Like, why are more companies not breaking good than 140? What is going on here? Do you know what I mean? That they're not able to get out from underneath. Now that to me is, while the other chart was a positive indicator, this is a negative indicator to me. And I don't really know how to process it, but my prediction is there's going to be some effort to figure out what's going on here.
I think if you look at the 140 as a percentage of the total going concerns in the prior year, if they've been coming down, it could be trending down just because there's been fewer going concerns in total over the last, say, 3 to 5 years. And therefore, the 140 as a percentage could be smaller, but be a consistent percentage of those. I'd rather see it as percentage versus this kind of a graph.
Yeah, the drop in percentage is not that great to say. I mean, here we are in this terrible time, right? We had, you know, kind of the worst recession we've had, I don't know, within, and that's true. We had significant real drops in sales and things like that. 266, 277, you know, versus 140 now. We're at half that level. Coming out now, the percentages aren't that great. In other words, the total numbers are not that great.
Your total numbers, I don't know, I forget.
Yeah, the total numbers were, you know, here are your new going concerns. You would expect them to be at high levels during these periods, right? So your new ones are going up, and then the ones coming out are the going bad and the going good. Okay. Now, this is going to be my third prediction. This chart is a chart by accelerated filers only. This is total number of material weaknesses. Total companies that had an adverse 404. Both the auditor and the company. So you can see here, you've got this trend. It keeps going down further and further. Adverse 404s are going the way of the dinosaur. The actual number of material weaknesses out there, you can say this is kind of the quotient for problems in the marketplace, consistently going down each year. Wonderful indicators of quality, advances in financial reporting, et cetera, et cetera. Now look at this. This is your non-accelerated filers. Now, someone asked me about accelerated filers and non-accelerated filers, how many there have been. Roughly over the decade that we've been, well, I guess it started in '04, that we've been tracking accelerated filers, non-accelerated filers, have been roughly equal numbers. 6,500 non-accelerated filers, 6,500 accelerated filers. Now, in terms of actual companies still in business today, those numbers are considerably less, like 4,000 and 4,000. But they're actually roughly the same. An accelerated filer is someone who has a float, a public float, under 75 million. Okay, so public float, again, that could be a bigger number than just the public float part of it. So here we have non-accelerated filers. These are your smaller companies. Total companies issuing, going concerns, adverse 404. This is self-assessment. And the actual number of material weaknesses being disclosed. There's been no improvement whatsoever in the overall quality of financial reporting for non-accelerated filers. And my prediction is someone's going to find that unacceptable. One of these regulators is going to find this unacceptable. And there are, I think that there are probably significant issues in this arena, including I suspect, at least in conversations I've had with people, that a lot of smaller companies are just giving themselves an adverse opinion. We don't care. We don't care. We're not going to do the work. We don't care. We're just going to give ourselves a, segregation of duties issue and just move on. I think that's going to, my prediction is that the SEC is going to do something about this. Now what, I'm not sure, but I have heard it discussed that one of the things that may come up is maybe a lower form of auditor attestation, a review, not an audit, something considerably smaller and less intense, where the auditor has to say, we've reviewed, the internal controls of these companies, et cetera, and we have the following opinion. I don't know. But something's going to happen on that. Okay. Okay, we got Q&A. And I think we have 5 minutes left, 5 minutes left. Okay. So anyway, like I said to you, the topic IFRS conversion and adoption and SEC activities, not much is going on. In summary, I don't think you have to worry about IFRS adoption at all. Think conversion. It's going to happen over 20 years. Eventually, they'll get to something that they agree with. Hopefully, it'll be the best translation of economic activity as opposed to a comparable one. Okay, that's where I suspect we're going to get to. SEC activities. There's a big, musical chairs going on. Not much is happening. They're trying to implement Dodd-Frank for those companies that most of us don't care about. And you don't really have to, I don't think you really have to worry about much at all. I tried to give you an idea of kind of if you guys are interested in looking at kind of what Corp Fin's thinking for your companies, then, obviously I'd be happy to, give anyone access to take a look themselves. And then as I said, I have my predictions. My predictions are something's going to happen on restatements, that the revision restatements, the stealth restatements, they're getting higher and higher. In fact, for the big four, those numbers are like 80-20 now, not 65 as they're on that chart for everybody. And something's going to happen bad, and that's going to go in the opposite direction. The 404 for smaller non-accelerated filers, something's going to happen on that. I just think it's just kind of, when you see the data, you kind of go, okay, well, it's just a matter of time. So anyway, I told you guys I'd try and make it interesting, even though not much is going on. So let me know if you have any questions, and if not, we'll just call it quits.
I suppose that, I think that if someone said, well, what are the top 5 points or pain points of where the SEC or FASB and the International Accounting Standards Board really need to sort of focus on convergence? What topics would they be?
Okay, I'll tell you. Imagine this scenario. The chairman of the SEC has a seat at whatever the committee is that's determining the new revenue recognition rules for insurance companies. Okay, complex, very complex area of accounting. And she's been told by the chief accountant that it absolutely has to be such and such. And a presentation occurs and someone says, we really need to make this much simpler so that insurance companies can have much more decision. They can decide how they want to do this, and we don't want it such and such. And they put that forward, and then there are 8 votes, and they're, from countries around the world, and a lot of them who don't even like the U.S. would just love to, kind of like just, snub one little, yeah, we're going for the new rule. Sorry, Mary Jo White. Sorry. That's the new rules. You're going to have to follow it. Okay, try that. Picture that scenario for a minute. And then think what happens after that. We're out of here. We're done. This is over. Whatever it is. Now, will that happen? Would that happen with the adoption of IFRS? Yeah, it would. I feel fairly certain it would. Is there going to be a legislative kind of a legislative requirement? No. So anyway, kind of in the, like of the 5 top issues you're talking about, the big one is, the gigantic one is, it ain't going to happen. It's not going to happen. Any other questions? All right, great. Thanks. Thanks, guys.